In this video, we're going to look at selling on credit. Whenever companies sell on credit or sell on account, they are not getting paid immediately. Let's take a look at a brief illustration. So here are two companies. We've got the Cowboys organization and we have Pepsi Corporation. And Cowboys wants to buy Pepsi products. So Cowboys will place an order. Pepsi will deliver the product. This could happen multiple times during a month. So every time Pepsi delivers a product to Cowboys, rather than getting paid and Cowboys cutting a check, Pepsi and Cowboys may decide that they're going to be buying and selling on credit. So what will happen is every time Cowboys place an order, Pepsi will deliver the product, but they're not going to collect cash for that delivery. Pepsi will keep track of all the orders placed by the Cowboys, and at the end of the month, they will bill the Cowboys for whatever purchase they have done. Then Cowboys will have about 30 days to pay Pepsi back for all the products that they bought the previous month. So this is called selling on account or selling on credit. So you will see the term selling on account or selling on credit. They both mean the same thing. Now, let's take a look at these two companies. Who's the buyer and who's the seller? Cowboys is the buyer and Pepsi is the seller. Pepsi is selling on account or it's selling on credit. So in this section, we're going to be looking at transactions for Pepsi. Later, we're going to look at buying on account. So Cowboys is the buyer, and later we'll take a look at the transactions for buying on credit. To recap, when selling on credit, it's also called selling on account. When companies sell on credit, the company does not receive cash immediately. Customers may take up to 30 days or sometimes more, depending on the credit terms, to pay the cash owed to the company. Accounts receivable is the account that we will use to record any amounts due from the customers for credit sales. So far, whenever we've looked at companies selling, we've looked at cash transactions. Whenever a company earns revenue, we said cash increases and revenue increases. However, whenever a company sells on account, revenue increases, but cash does not increase because the company has not received cash yet. Instead, an account called accounts receivable will increase, and that's the account that shows the amounts due from customers for those credit sales. Accounts receivable is an asset account. Let's go take a look at an example where we are selling on account. In this example, it says Ardent Company experienced the following events during its first year of operations, year 1. Again, we are Ardent Company and we're going to be looking at transactions from our point of view. This is the first year of operations, so before these transactions occurred, the company had no assets, no liabilities, no stockholders' equity, no revenues, no expenses, and so on. They want us to use a horizontal financial statements model to show how each event affects the balance sheet, income statement, and the statement of cash flows. Let's look at the first transaction. Transaction 1 says, acquired $200,000 cash from the issuance of common stock. So what happened here? We got cash by issuing common stock. We know that cash is an asset, so under assets, I'm going to say cash, and then we know for transaction 1 our cash increased by $200,000. What else happened in the balance sheet? Well, we also know that we issued common stock, so our common stock increased. Common stock is a stockholders' equity item, so under stockholders' equity, I'm going to have a column that says common stock, and common stock increased, so we're going to have $200,000 of common stock. That takes care of the balance sheet. Now let's take a look at the income statement. How did this transaction affect the income statement? Well, income statement only has revenues and expenses. This is not a revenue or an expense, so the income statement is not affected by this transaction. Now let's take a look at the statement of cash flows. Did this affect the statement of cash flows? Yes, it affected cash, so it affected the statement of cash flows. Cash flows increased by $200,000, so we had a cash inflow of $200,000. Now we need to tell them what type of activity. What type of activity is this? We know there are 3 types: operating, investing, or financing. Anything to do with common stock or loans, paying back or receiving long-term loans, are financing activities. So this is going to be a financing activity. Let's look at transaction 2. Transaction 2 says, earned $10,000 cash by providing services. So now we are providing services and we received cash of $10,000. So we know that our cash increased by $10,000. What else happened? We know that whenever we provide services, it's called revenue. So we earned revenue. Our revenues increased. How does revenues affect the balance sheet? We know that revenues has the effect of increasing stockholders' equity. What particular component of stockholders' equity? It's going to be retained earnings. So I'm going to put a column called retained earnings here. And revenues have the effect of increasing retained earnings. So we say that retained earnings increased by $10,000. That takes care of the balance sheet. Now let's look at the income statement. Did this transaction affect the income statement? Did we get revenues or expenses? Yes, we did. We said our revenue increased by $10,000, so therefore it does affect the income statement. Our revenues increased by $10,000, so I'm going to put $10,000 in the revenue column. How did that affect net income? Revenue minus expenses is net income, so net income also increased by $10,000. Did this affect the statement of cash flows? Yes, it did. It was a cash transaction, so it affected the statement of cash flows. Our cash increased by $10,000, so we had an inflow of $10,000. What type of activity is it? Revenue is a day-to-day activity, and therefore it is an operating activity. Anything to do with day-to-day activities is called an operating activity. Let's look at transaction 3. Transaction 3 says we earned $75,000 revenue on account. So this time also we earned revenue, $75,000. But did we get any cash for that? No, it says on account. So if it says on account or on credit, we know that that is a credit sale. So how did this transaction affect the balance sheet? We know that revenues increased by $75,000. So we know that revenues have the effect of increasing retained earnings. So I'm going to go to the retained earnings column and put $75,000 as a positive number. But what else changed in the balance sheet? Well, now we know that we have another asset called accounts receivable. Accounts receivable shows how much is due from customers for credit sales. So for this transaction, our accounts receivable increased by $75,000. Now we're done with the balance sheet. Let's look at the income statement. Did this transaction affect the income statement? Yes, it did, because we earned revenues of $75,000. So our revenue increased by $75,000, so I'm going to put that $75,000 under revenue. It also affected net income. It caused net income to go up by $75,000. That takes care of the income statement. Next, let's look at the statement of cash flows. Did this transaction affect the statement of cash flows? Did we receive any cash? No, we did not. If you look at the cash column, there was no cash in this transaction. Therefore, this transaction did not affect the statement of cash flows. And we leave that blank. In your homework, some of the blank columns may need to be filled with NA, so be careful and check the instructions in each question. Let's take a look at the fourth transaction. It says collected $60,000 off the balance in accounts receivable. So in this example, or in this transaction, we are receiving $60,000. Our customers are paying us $60,000. We know that our cash increased by $60,000 because we collected it. So $60,000 goes as a positive number under the cash column. What else happened? Well, now our accounts receivable has decreased because we collected $60,000 from these accounts receivable customers. So our accounts receivable goes down by $60,000. I will put that as a negative number, and it'll show that accounts receivable decreased. That takes care of the balance sheet. Let's look at the income statement. Did we have any revenue? We collected $60,000 cash, but that was not new revenue. That was from the previous revenue of $75,000. We just collected it. So the income statement is not affected by this transaction. We did not earn any new revenue. Did this affect the statement of cash flows? Yes, it did. We collected $60,000 cash, so our cash increased by $60,000. We have an inflow of cash of $60,000. What type of activity is it? Well, these $60,000 was for sales that we did previously, so it was cash collected from customers. Therefore, it is an operating activity. This is a very simple question to help you understand accounts receivable and to show you how the transactions affect the three financial statements. Make sure you rework this question over and over again until you are comfortable with how to record account receivable transactions. That's it for this video. Please let me know if you have any questions.